Unidos, principal mercado consumidor de café. Una mirada que nos presentará Fernando Soto, vicepresidente de banca privada de Brown Brothers Harriman. Le damos, por favor, la cordial bienvenida.
Welcome, everyone. Thank you so much for joining me today in Sinter Café. I'm very excited to have the opportunity to be here today in front of so many successful business owners and private executives here in this conference. This is very exciting for me because this is exactly what I do on my day-to-day basis. I advise private business owners in the entire cycle of wealth, from the creation to the transition to the growth of their wealth. For those who don't know me, as mentioned, my name is Fernando Soto. I am a Senior Vice President of Brown Brothers Harriman. I've been advising clients for over 7 years, many in the coffee business. And for those who don't know BBH, Brown Brothers Harriman, BBH is the oldest privately owned bank in the US. It was founded in 1818. The bank started actually as a merchant bank. So this is the exciting part of it because we have a very rich history in the commodities and trade finance business, specifically in coffee. Coffee is actually one of the oldest businesses. We started financing coffee in 1857. So we continue to do it, thanks to the support of many of our clients, which include many of you here today. So this is the first time that I'm actually, this is the third time that I'm actually presenting at Sinter Café this year. The last time was in November of 2019, and prior to that, November of 2017. And in those two occasions, the topic of the presentation was, when is the US economic cycle going to end, aka when are we going to head to a recession in the United States? And I mean, I even remember many folks trying to get me to tell the answer to that question, to get a prediction of when we are heading to a recession. Even at the bar, people were trying to buy me drinks to convince me and press me to get them an answer when we're going to enter a recession. And I see many familiar faces here who tried to do that. So unfortunately, at the time, it was very, very difficult to make a prediction on when we were heading to a recession. Absolutely every single economic indicator was trending up, even though we were in the 11th year of an economic expansion. So it was very, very tough for us as economists at Brown Brothers Harriman to make a prediction on where we're heading to a recession. However, I'll say that this year, that has changed. I have some good news and bad news about this year after 3 years. The good news is that, number one, I think I have not gained weight since the last time I presented here, and it's hopefully not. This is 2017 though, so that one I probably a few pounds over. Number two, and I think more importantly, and jokes aside, today I feel very confident that I can answer that question on whether we are or we are not heading to a recession in the near term. The bad news is the answer to that question. I do believe that we are heading to a recession in the near term, sometime next year. However, I also believe that that recession should be mild and short, and I will talk about some of these aspects in the next slides. The other bad news is related to financial markets, and you've probably seen it this year. I will start by saying that given the current macroeconomic environment, this year has been a very challenging year for all asset classes. Literally, there was nowhere to hide in terms of asset allocation and asset classes. Every single asset class was negative. However, I think as we get closer to the fourth quarter, the macro narrative will begin to change, given three main macro characteristics. One, I think we're going to begin to see a slowdown in the housing market. We are already starting to see a slowdown in the housing market, and we think that will continue to happen. That's number one. Number two, at the same time, we're also beginning to see a slowdown in the housing market in the US. There's a lot of regional variety in the housing market, but overall, I will show some slides for this as well, but we're seeing the rise of interest rates, the oversupply as well in the housing market. That's why we're seeing a downturn in the housing market. Number three, I believe that in this quarter, we're also going to see a slowdown in inflation numbers. We just got fresh data from inflation CPI numbers yesterday, 7.7%. The last one was about 8.3%. So we're seeing a downturn in inflation numbers as well. So when you think about it, those three things, the labor market, housing market, inflation. So a combination of all these three things should create an opportunity for the Federal Reserve to begin easing back on the tightening of interest rates that began on March of this year, and likely be done with the tightening by the end of the first quarter of next year. So that's a good scenario that begins to lift some of the pressure out of the equity market. So we have some negative sentiment on the equity market this year. So that slowing down on the rate increase should begin to lift some of that pressure. And we are watching that very closely at Brown Brothers Harriman. Of course, what's interesting about this narrative, if that scenario is true, markets might begin to turn and begin to rally just as economic activity happens to look a little bit worse. So the economy, we have a slowing labor market, we have a slowing housing market, we have inflation coming down, we head into a recession and the markets begin to rally. So that's an interesting paradox that we're seeing in the markets right now. And just as a reminder, markets are a discounting mechanism. The equity markets never trade on today's headlines. They always anticipate the headlines. So that's where we're seeing that the market's already pricing a potential recession sometime next year. So that's the story of the summary. I don't know, Elia gave me 1 hour and a half to talk about economy today. And so it won't be an hour and a half, it will be a little shorter. But if that's the summary of what we are seeing, and I'm going to go touch on different aspects of the economy over the next slides. So one of the big data points that we received a few weeks ago was the third quarter GDP data. And you will recall earlier this year, because the first and second quarter GDP numbers actually came out with negative signs. And that scared everyone. I had clients calling me and asking me whether we are heading to a recession, whether we are in a recession, given when we have two negative numbers for GDP for the first quarters. So all those sort of questions start coming up. That's why GDP became such an important data point for all economies. So all of those conversations are still in place, and we'll continue to assess the impact of that. But the third quarter GDP data that just came out came in with a positive 2.6%. So that kind of puts to rest the notion that we are ready in a recession, but we're still trying to figure out what happens next. As you know, the most important piece of GDP is what you see in this chart, the red chart, the personal consumption. That continues to be the case as well. And I think I mentioned this before. Last time I was here, last year I did a Zoom for Sinter Café. Personal consumption is the most important aspect of the GDP, the component, the real engine of economic growth is personal consumption. So as long as you see all Americans, including myself, going shopping and buying and taking trips and enjoying restaurants, that's personal consumption. That drives about 70% of GDP. That's why it's so important when we think about personal consumption as a driver of economic activity. So what I'm showing here, just to orient you, on the right side of the chart, you see all the contribution of GDP growth for the past 7 quarters. So you can think about the last data point here being the third quarter of this year. So all quarters of 2021 and the third quarter of 2022 here as well. The very left-hand side of this chart, for context, is just the average of the decade preceding the pandemic. So it's 2020 to 2019, that's the average. We're trying to normalize that data just because the pandemic was just an unusual period. So what we did is we took out the pandemic out, 2020 to 2019, that's the average that we see. The good news is that all these red charts, you see they're all trending on a positive side, so they're all up on a positive trend. That's the big takeaway, that's the good thing. That's the heart of the economy again. And even in the first and second quarter of this year, when overall GDP was negative, personal consumption was still positive. Again, that's 70% of GDP. That's good news. And over the past 4 or 5 years, if you can see in the left side of this chart, you see that leaving aside that rebound of the pandemic, personal consumption has been adding about 1.6% to GDP historically. Now, when you look at the blue bars, that's business spending, that's where the story begins to get a little bit more interesting. The blue bars here are business spending, and we can see that historically, on average, business spending has been about a contributor of about 1% to GDP growth. But this is an extraordinary amount of, you see a lot of variability, a lot of volatility in that number. And what we're seeing, particularly in the fourth quarter of 2021, early 2022, are the effects of supply chain disruptions. And you know this very well, what happened in this story. So in the first quarter of 2021, the panic and anxiety that happened of supply chain was such that people took every inventory that they could get. So all that inventory built in 2021 added a lot to GDP. And you see that number, 5.1%, as the last quarter of 2021. And you saw that. There was overproduction. There was too much stuff put on shelves, which meant that the next quarters you didn't need to produce that much. That's why we saw a drop in business spending in terms of GDP. So you see that. I'm going to circle here in red what I'm talking about. 5.1% at the end of 2021, and then you see a drop to less than 2.8% in that drop. So if you think about it, that's the last quarter just ended. It subtracted pretty much most of the growth that we had last year. So I think we're seeing that inventory is still wearing off. You can see that at the retail level as well. You are pretty familiar in the coffee. You overproduced last year just in case production, and that's what we're seeing. That we saw that big drop in terms of the inventory. Government spending in green, that's the other piece that I think is interesting. It's pretty much flat. I'm going to get it out here. So you see historically has been pretty flat as terms of a contributor to GDP growth, and it remains close to zero in the last quarters, which really tells us the story that the real driver of GDP growth in the U.S. it's really the private side of the economy, whether the personal side or the business side. What's really driving U.S. economic growth is the private side of the economy. The last variable here that we see is net exports, which is, of course, a contributor that depends on the strength of other economies. So historically, it has been a little bit of a drag in GDP. If you look at the left side of the chart, you see it's at minus 0.2% historically. It's been a drag in terms of GDP growth. And the reason why it's been a drag is because the U.S. has a trade deficit. So in the U.S., we end up consuming more than we produce and export. So that's somebody else's GDP. It's not the U.S. GDP. It's India's GDP, a contributor to China's GDP or Costa Rica's GDP. Here, too, we can see that we have seen a real twist from a historical average. Again, kind of a rounding error close to zero. Net exports were a drag of GDP of about 3.1% in the first quarter of this year. But in the third quarter, it added about 2.8%. So a lot of clients were asking what's going on here, why there was such a big twist in terms of exports. And I think what we're seeing here is that the rest of the world is actually catching up with the U.S. in terms of an economic rebound from the worst days of the pandemic. So in the first quarter of the year, we were doing okay. We were consuming a lot of external products. But as the rest of the world began to recover, that kind of balances out. And that's why you see a huge swing there as well. If you calculate quick math between minus 3.1, 2.8%, it's about a 6% swing in just a handful of quarters. So for the rest of the presentation, I am going to focus on the red side, on the red bars, or the personal consumption, as I mentioned. And I will remember, everyone, if you have to leave this room, remember personal consumption is the driver of GDP. And I'm going to focus on that over the next slide. So I think there are 4 developing headwinds that we're seeing for personal consumption in the U.S., one of them being the labor market, number 2 being the housing market, number 3 being personal savings, and number 4 being consumer confidence. And we'll go over some of these slides over the next pages. So on the labor side, we can now finally say that in the U.S., the labor market is fully, completely recovered. The labor market is all the way back to where we were in February of 2020. And at the same time, what we're seeing is that there is a gap in supply and demand. That gap that existed in supply and demand for labor is starting to tighten. So it was very difficult for me, as I manage a team of about 15 people in New York, and it was very difficult to find talent over the past 2 years. You probably experienced something similar. It's becoming a little bit easier. We've seen that the gap in supply and demand is actually started to balance out, which is becoming more of a normal labor market in the U.S. for us. So now, that is one of those paradoxes, again, that if that continues, if those job openings actually start coming down, and we anticipate at Brown Brothers that that's going to happen, the headline is that the economy is slowing down. But in reality, what we're seeing is just more normalization. We're coming to a more normal labor market compared to the previous 2 years. So if this plays out again, we'll begin to see a slowdown in the monthly job gains. So what you're seeing here in this page are monthly net job gains in the U.S. So you see the different months that happen. So the last data point here, did the job gains scare the team here? I'll wait for you guys. Are we good? Okay, we're back. I think everyone was getting nervous about the job gains. The last data point here is as of September. So you see different months here in the job gains that we saw. You saw a huge spike during the rebound during the pandemic. And the last data point here as of September, 263 jobs added. And you can kind of see from this chart that is the lowest. That's the lowest net job gains of the past couple of years. And we just got data as of last week, Friday, as of October. The U.S. economy added 261,000 jobs, so even lower. And we expect that number to continue to decrease or at least stay flat. So again, for context, I think context it's pretty important here. Outside of the recession, prior to the onset of the pandemic, a monthly gain of 261,000 jobs, it's great news. But when you look at the past 2 years, of course, you see in the numbers, when you average about 450, 500,000 jobs per month for the past 2 years, yeah, of course, this is a slowdown in terms of a job gain. So as of many aspects of the economy, what we're seeing here and what we think is happening is a more normalizing the labor market. It's becoming, in the news, you're seeing a slowdown in the labor market. The Fed is looking at it as a slowdown in the labor market. We're seeing more of a normal levels of economic activity in the U.S. So let's talk about the housing market. Yesterday, we were talking about, at the happy hour, many folks were asking me what's going on in the U.S. housing market. Should I buy an apartment? Should I sell my apartment? I don't know. I'm not a realtor. I'm not familiar with that. But I can tell you at a high level, at least, what you've seen here in this chart is median U.S. home prices in blue and year-over-year changes in red. This is another interesting paradox. So you see that housing prices are actually rising at about 7% year-over-year. However, when you look at these lines, they're both trending on a downward direction. So what's happening? There's two things I think that is happening in this chart. Number one, where we're seeing that there is a lot of delayed in housing supply. So houses that were built in 2020 and were delayed in 2020 are actually coming into the market. So we're seeing that oversupply, delayed supply coming into the market. So you have oversupply, and of course, demand is start to coming down as rates continue to increase. So we're seeing that playing out. The supply and demand imbalance is actually causing those two lines to actually trend downward. So mortgage rates. I just updated this chart as of end of October. These are 30-year mortgage rates in the U.S. And you see here a little bit over 7% for a 30-year mortgage. So for me, what's remarkable is not only that 7% number. What is more interesting for me is actually the rapidity that we have seen the mortgage rates come up. You can look at this chart. Beginning of 2020, we're talking about 3%. All of a sudden, within just a handful of quarters, you saw a rapid increase in rates. So a house that might have been affordable 6 months ago, where mortgage rate were 3-4%, at 7.22% is just no longer affordable. So that's what we're seeing. That's why that demand continues to drop, but we're seeing over excess of supply. So you have a combination of supply, at the same time you have decrease in demand. Now, I don't want to alarm anyone. This is not an 08, 09 situation. It's not even close to it. But at least at margin, those prices are coming down. So far we talked about two potential headwinds to personal consumption. Number one, we talked about a softening labor market. Number two, we talked about a softening housing market. And number three, the third one I think is an important one, is that if you recall from the pandemic, the economy basically shut down. And we had government support programs that injected liquidity to U.S. households. So we had unemployment benefits. We had support programs for small businesses and medium-sized businesses. So that injected a lot of liquidity to U.S. households. But we were stuck in our apartment. We couldn't consume. We couldn't go out. We couldn't go to bars. We couldn't go travel. So we had a lot of excess savings. And that excess savings is calculated in this chart by looking at the difference between disposable income and personal spending. So I would say about a year and a half ago, when I was showing this exact same chart at Sinter's Cafe's Zoom session, an economic update, we were looking at about $6 trillion in savings for U.S. Americans. That's how much money entered households, but they couldn't spend it, so we had excess savings. What we're seeing now is that those savings are actually starting to evaporate. So today, as of end of September, U.S. households are at about $1.2 trillion in savings. It's still a lot of money, but when you look at the historic average pre-pandemic levels, you're talking about $2 trillion in savings. So arguably, not only the excess savings are actually coming down, but household Americans are actually running pretty tight in terms of savings as a whole. So here's a third headwind. You have a labor market that is softening. You have a housing market. You have diminished savings. And of course, that's leading to a drop in also consumer confidence. And we can see that in the next slide. So this is just a survey of how consumers feel about the economy, how consumers feel about consuming goods and services. So you see in blue the current conditions. You see in red the future expectations. And I think you have seen this slide before. This is more of a psychological disposition. So the way personal consumption works, if you think about the psychology of the economy, is that if you feel wealthier, if you feel richer, you're going to consume more. So this tries to get that psychological disposition to consume. And again, 70% of GDP is personal consumption. So this is a very interesting chart, and it's an alarming chart because you see that it's trending lower. However, if you were to be an optimist, you might look at this chart and you look at the last 2 data points, September and October. It actually ticked a little higher. So you could argue that we might be turning for the better. That is possible. However, when you look at those 4 headwinds that we just described, labor market, housing market, diminished savings, and confidence, it definitely paints an economic picture that the economy is slowing down. And that's the narrative that we are seeing unfold this year. With all these headwinds, therefore, I think we're seeing an increasing likelihood of recession. So going back to my first question, are we heading into a recession? I think we are heading into a recession. All these headwinds that I'm just describing are increasing the likelihood of a recession in 2023. We believe, again, that will be mild and short for various reasons that I'm going to touch on over the next slides. So one of the reasons that we believe that if we do head into a recession, it will be mild and short is because household Americans are actually in pretty good shape. And we can see that in this slide. There's a cushion, a financial cushion that is in place that wasn't there during the last recession of 08, 09. So what you see in this page is debt relative to income. So how much debt U.S. households have related to income. So you see back then in 08, 09, we were at 134% in terms of debt relative to income. Today, as of end of June, we're about 100% of that. So it's a huge dramatic drop, down substantially from 15 years ago. So that's good news. Household Americans, in terms of debt relative to income, much better than 08, 09. This is another chart. This looks at debt relative to assets. Very similar story, down substantially from 08, 09. And I didn't include it here. Somebody asked me this question last night. What about debt delinquencies, household debt delinquencies? I didn't have time to add this slide last night, but debt delinquencies, credit card delinquencies is also a huge drop compared to 08 or 09. So the psychology of household spending might be declining, but the reality of household financial strength is still in pretty good shape. So that's pretty good news. So I'll conclude here that if we see a recession in 2023, and the likelihood is rising again, I'll remind everyone it's not going to be an 08, 09, 01. I think it's going to be a very mild and short recession. Somebody asked me last week on a presentation that I did at a different conference about, okay, we talked about U.S. household. What about corporate America? How corporate America is doing? And what about banks? How is the liquidity of the banks? Are we going to hit a Lehman Brothers situation again next year? So I added a few more slides here to show that. This is a very simple slide that just shows cash on some of the largest corporations in the U.S. So think about the S&P 500. We're looking at cash here on the balance sheet. So prior to the financial crisis, when you look at this chart, it's 08, 09, you're looking at a little bit below $200 billion in cash. Today, where we are, $1.6 trillion in cash in corporate America. So that's great news. There's financial strength in corporate balance sheets in today's environment. Bank liquidity, this is basically bank balance sheets. So the way we get regulated and we get scored, it's on the liquidity of our portfolios in different banks. And you have Morgan Stanley, Goldman Sachs, JP Morgan. I did not include Brown Brothers Harriman here because we're privately owned and we're not supposed to disclose our liquidity. But we're actually in much better shape than all these banks. Just you have to trust me on that one. So briefly here, back of the envelope, Tier 1 capital ratio at a handful of U.S. large banks. In blue, you see June of this year, and in red, the data as of 08. So you're comparing 2022 with 08 in this data right before the financial crisis. And in every single case, as of the second quarter of this year, in every single bank, we have way higher Tier 1 capital ratio than in 08, which is good news. The bad news is in the next page. The bad news is related to inflation. So again, we are heading to a recession. It's going to be mild and short. We have more liquidity in corporate America. Banks are in better shape. U.S. households are in better shape, but we still have the issue, and I think that's the hot topic that we have to deal every week, which is inflation. So here we have consumer inflation measured in terms of CPI. As of September of this year, U.S. inflation was at 8.2. I didn't update this chart because inflation just came out yesterday, the new number. We are at 7.7% inflation number as of October. However, when you think about the data of September or October, it represents the fourth month in a row of decline in CPI, which has been frustratingly slow. At BBH, we actually anticipated that inflation was going to slow down at a faster rate. It hasn't. But it's good news that we're seeing actual inflation start to come down very slowly, but it's coming down. And at BBH, we're confident that that inflation figure will continue to drop for two main reasons. Number one, and you are very familiar with this, the recent downturn in the underlying commodity prices, in particular food and energy. In the past 12 months, we have seen lumber down about 33%, aluminum down 24%, oats are down 16%, cocoa down 9%, and other continue to normalize, and you're familiar in the commodities space. And number two, pent-up demand. Again, I talked about it. Everyone was locked in your apartment. You had liquidity, but you couldn't spend it. All of a sudden, the doors opened. You started traveling. You started going to restaurants. All that pent-up demand already has been spent. Excess savings have been decreasing, and that's what we're seeing a slowdown in inflation as well. And we expect that slowdown to continue through the next months as well. So as long as those two factors take place, the expectation is that inflation will continue to come down and be normalized. Potentially, probably by the end of next year, we'll have a more normal level of inflation level. So again, the story that is developing here is that if we get a slowdown in the consumer part of the economy and we get a slowdown in inflation, it might open the door for the Fed, the Federal Reserve, to slow down and potentially end the tightening of interest rates. And the future markets are beginning to anticipate that, and we can see that in the next page. So federal funds rate, this is how we measure interest rates in the United States. So where we are right now, the federal funds rates in green, we can see that today, roughly about 3%. And you can see the market was anticipating another pricing of about 75 bips in November, which already happened. They increased 75 bips, so this chart is a little bit outdated. And we see that the Fed fund rates actually peaked in early 2023, and they follow by a relatively flat over the course of the year. So we see that the expectation, this is again market expectation, this is not Brown Brothers forecast, but the expectation is that the rates will peak at about in the next year, May, end of Q1 of next year at 5%, stays pretty much flat, and you see that in 2024 actually starts dropping. So that's what the market is expecting, pretty much aligning to our expectations. We think Q1, depending on inflation, rates will slow down, will actually flatten out, and then in 2024 we should start seeing a decline in rates. The other interesting development is the break-even spreads that we're seeing. And just to explain this chart, this is, in simple terms, this is just what the market expects inflation to be over the next 5 years and over the next 10 years. So 5 years in red, 10 years in blue. And we can see here that the market over the next 5 years expecting inflation to be 2.66, over the next 10 years 2.51. It's so interesting because we're at 7.7, and the market is anticipating about 2.5% of inflation over the next 5 to 10 years. So it's a very interesting expectation. I think what the market is seeing, it's anticipating that normalization in commodity prices, and at the same time, that pent-up demand is starting to normalize. So again, as a reminder, the market always anticipates things, and that's how you have to trade when you're thinking about asset allocation as well. Now, quickly turning to returns, fixed income returns here for various asset classes. You see U.S. Treasuries in blue, you see municipals in red, you see investment-grade corporates in green, and high-yield, non-investment-grade corporates in gold. What's interesting about the fixed income market this year is that a lot of investors forgot that there is volatility in the fixed income market. You think everyone talked about U.S. Treasuries like risk-free rate, there's no risk. But there is volatility in the market. And what we're seeing here, it's the story that we're seeing this year. And you see here, the U.S. Treasury is down 14.8%. So if you bought a bond January of this year, a 10-year Treasury, your bond would have been down about 15%. The same thing happened for municipals. The same thing happened for investment-grade corporates. So what we're seeing, the story of fixed income this year, is a story of interest rate risk. There is no credit risk yet being assessed in the fixed income market. So the reason it's dropping is just simple bond math. So as interest rates go up, bond prices go down. And we have seen that happen this year, and that's what you see in the drop. So far, we haven't seen a lot of credit risk issues in a lot of these bonds. What we're seeing is more of an interest rate risk that we're seeing. So at Brown Brothers, what we did, beginning of the year, we were already anticipating that there was going to be an increase in rates this year. So what we did is we shortened our duration. So the shorter your duration is in fixed income, shorter the maturity of your bonds, the less volatile are against interest rate increases. So the shorter duration, the less risky, less volatility. So we shortened our duration to about 7 months. So you think about these are 10-year bonds. So we shorted to 7 months. Our bonds were down 2% instead of 15%. So that was a good tactical call, anticipating that increase in rates. So if you're thinking about buying fixed income right now, it's for the first time we're seeing an interesting investment opportunity in the fixed income market. Personally, I'm an equity investor. I would say, and I was sharing some thoughts when people were asking me yesterday what I'm investing money today. I'm an equity investor. I love equities, both private and public. Most of my portfolio, about 100% of my portfolio has been 100% equities over the past years. Recently, we've seen rates increasing, and I'm actually shifting, for the first time, I'm shifting towards, this is not my client's portfolio, this is personally, I'm shifting towards fixed income. I'm able to get about 6-7% rates right now for short duration bonds. Munis, I'm getting 6-7%. Non-traditional structured credit bonds, I'm getting 8-9%. If I can get 7-8-9% on a short duration bond, I'll take it any day. So my advice, if you have your portfolio, start looking at fixed income. It's a source of liquidity. It's a source of stability. And now, finally, after many, many years, it's becoming a source of income for the first time. Next page, equity returns. Here we see equity returns for all the different equity asset classes. In blue, large cap. In red, small cap. In green, we see international equities, mainly Europe, and in gold, emerging markets. I added the October returns on purpose, and I just added this about 2 nights ago. I never like showing short-term returns October, but I had to add it just because for the first time we've seen positive numbers after a year in the equity market. So I saw the positive signs. I had to add it. My firm doesn't like when I show short-term returns, but I just wanted to add some enthusiasm to the presentation. So October was a good month. Historically, October is typically the worst month of the year in terms of investing. It's not perfect, but majority of months of October actually shows negative signs, or at least flat market returns. Here we see a big difference. October is actually up. The S&P 500 up 8%, small cap up 11%, international equities up 5%, emerging markets continue to suffer this year, down 3% in October. What's interesting for me, and the reason I also wanted to add the October data here, is because as good as the S&P looks like, it's 8.1%, that's the blue bar. The red bar, small caps, actually did a little bit better. And that's interesting because that tends to be an indication of domestic economic health. You know, a lot of the smaller capitalization stocks tend to have more of a domestic exposure than international exposure. So there's not a lot of small cap multinationals. So there's a lot to read about that. It shows that perhaps Europe is in a recession. The US is in better shape, perhaps. And I think that's the case. A lot to read, but just an observation that I wanted to add to this chart. From a year-to-date basis, there was, as I mentioned in the beginning of the presentation, there was really nowhere to hide on the equity market. Absolutely all equity asset classes posted negative signs. So you see the S&P 500 down 18%, small cap down 17%, international and emerging markets down more than 20%. Within the S&P 500, we were to zoom in inside the S&P 500, the only sector that actually posted positive returns, there's only one sector that posted positive returns in the S&P 500, that was energy. Energy was up about 40% this year within the S&P 500. So that's good news for energy investors. Unfortunately, I gave credit to Brown Brothers for shorting duration in the previous slide. I'm going to have to admit, we didn't have any exposure in the first quarter of this year. That hurt some of our equity performance. We're tilting more towards technology. It would hurt us. we are being adding to energy since the second quarter and added to more value-driven strategies. But so you were an energy investor, you did well this year. However, energy has been the worst performing sector over the past 10 years. So a lot of clients, and also yesterday at the happy hour, people were trying to force me to make a prediction on should I buy the equity market now? Should I sell? Should I buy bonds? When is the right time? When should I make the trade? It's practically impossible to time the market. Many traders and economists and hedge funds have been trying to time the market. And when you look at historical data, they always fail. So always tell clients to remain disciplined and avoid trying to time the market. Now, the good news is that, and I'm going to show you here, that market timing is not as important as you might think. So what you see in here is a hypothetical situation. If you invested $100 in the S&P 500 in February 19th of 2020, what will your return be as of September of this year? So the interesting part of this analysis is that this would have been the unluckiest investor, right? Because this will be an investor that decided to put all your money, your $100 to work, the day that the World Health Organization declared a global pandemic. So just before, the day before they declare a global pandemic, this investor came in and put $100, and this would have been your return as of September of this year. Cumulative return of 10%, annualized return of 4%, still a positive sign in front of that return. Now, this is a similar example. Now, if you invested the same amount of dollars prior to the bankruptcy of Lehman, and I'm talking about the day before the Wall Street Journal posted that Lehman Brothers was coming down, this is the investment that you would have made. And you can see from the chart, the short-term return on the left side actually downward dramatically, but after that, 280% of a cumulative return and an annualized return of 10%. One final example on market timing. This is investing the day before 9/11 happened. So you have a few episodes here. You have 9/11, you have the entire financial crisis of 2008, you have the global pandemic, and you have whatever we are in this period that we still don't know what to call it, the contraction of economic activity or market contraction. So you have 4 bear markets and 4 recessions, and yet your cumulative return would be 395% and 8% on an annualized return. So trying to time the market can be very costly, and it's not necessary. So that's the examples that I want to show here today is that the benefit of being a patient, long-term, disciplined investor pays out more than trying to time the market. So that's been always my advice to my clients. Every time you see the news, you panic, you have anxiety. Just don't let your emotions drive your asset allocation or your investment decisions over the long term. So in conclusion, a few things. I'll say, number one, and I'll repeat this because I think it's important for everyone to know, we're seeing a slowdown in the labor market. Remember that. We're seeing a slowdown in the housing market. That's leading to a consumer-led recession in 2023. We are not talking about a banking recession. We're not talking about a specific event that is causing the recession. It's just a consumer-led recession, which I think is going to be healthier for the economy going forward. Number two, and I mentioned this before, we talked about the strength of American households, the strength of corporate America, the strength of the banking system today. All of these 3 factors are going to make this recession very mild and short. And number 3, I think it's no news. Inflation is not transitory, meaning that the Fed will continue to raise rates until there is clear evidence that pricing pressure is easing. So investment implications, what are we doing at Brown Brothers Harriman? A few thoughts that I would like to share with you. The way we think about investing at BBH, we use volatility as a tool. We use volatility as our friend to identify investment opportunities. So we have seen a correction. We get excited, actually, when we see corrections because we can find things at a discount. So for you, when you look at your portfolio, use volatility as a tool to identify opportunities as well. That's the best time you can make an investment. Number 2, I said it, for the first time we're seeing opportunities in the fixed income market. Go ahead and check some of your muni bonds, check some treasuries, lock some 2-3 year bonds so you can get 4 or 5%. That's becoming interesting. I'm starting to rebalance some of my portfolios and allocating more to the fixed income market. And number 3, don't let emotions, again, drive your investment decisions. The best investments you're going to make are going to make during economic distress. And I was with a client last night having a drink, and he told me the best investment I made, it wasn't working with you, Fernando, and Brown Brothers. You're okay. You're a good asset allocator. But the best investment I made is actually buying an apartment in Miami in 2008. that was his best investment. So typically in economic distress, that's when you're going to find opportunities. At Brown Brothers Harriman, we're looking at many opportunities. We haven't been very aggressive on allocating to equities yet. We're still waiting to see what happens to inflation, but we're getting excited. I think soon enough, we're going to start rebalancing and start getting back to buyback form going forward. So again, a few final thoughts. Stay disciplined, don't be emotional, and take advantage of volatility to identify investment opportunities. Thank you very much for joining me today. Hopefully that was helpful. It's always a pleasure to be with everyone today. I don't know how much time we have for questions. No question. You guys can buy me a drink. So what I do typically when I come here is I give you an answer for a drink so we can trade. But thank you so much, everyone. I appreciate the time.